What's going on? Alex here, and today I'm going to be talking about bonus depreciation. Now, I'm not referring to the fact that your paychecks aren't what they used to be. Now, that's a separate issue altogether. Instead, bonus depreciation refers to a provision in the tax code that allows business owners to accelerate their depreciation deductions instead of taking it over a number of years. Now, if you've been watching my videos lately, you'll know that I released two of them on Section 179, which is also a provision in the tax code that allows you to accelerate depreciation deductions. So the question is, why are there two separate ones? Well, the fact that Section 179 and bonus depreciation both allow you to accelerate your depreciation deductions, that's essentially where the similarities end. And this video is going to be focused on the differences between bonus depreciation and Section 179, so you can see how the mechanics differ and which one may be more applicable for your business. Now, as always, depreciation can get very complicated very quickly, so make sure that you consult with a qualified tax professional before making any decisions based on the information provided in this video. So if you haven't already checked out my videos on Section 179, I'm going to include the links in the description below, and you may want to watch those videos, then circle back to watch this one. Because initially we laid a good solid foundation, and now we're going to build on the concepts discussed previously, so this can make a lot more sense for you. Now, to tie this all back to the videos I did on Section 179, you might remember that I looked at 5 different scenarios, which I'm not going to be looking at in this video. The reason being is if we compare bonus depreciation to Section 179, essentially we're going to be stuck in scenario 2 here, specifically because the cost of equipment purchased and placed in service is $50,000, and we took $50,000 in Section 179. So that's 100% of the acquisition costs of property purchased and placed in service. So being that bonus depreciation is an all or nothing provision in Tax Year 2018, thanks to the Tax Cuts and Jobs Act, we can take $50,000 or nothing at all. So if bonus depreciation is applicable in a particular tax year, essentially, this is the scenario that would play out. You just substitute bonus depreciation for Section 179. So on the tax return, things would look pretty similar, and the amount of taxes you'd be subject to would be similar as well. So that's why I'm not going to be taking a look at multiple scenarios in this video, because essentially we'd be covering scenario 2 that we looked at in the videos pertaining to Section 179. Now, the big question is which assets qualify for bonus depreciation. And for a quick and easy answer to that question, we can rely on the trusty IRS website. Let's take a look. So here we have the Cost Segregation Audit Techniques Guide for bonus depreciation. And as you can see, this is a quick and easy explanation. Nothing complicated here. It's right to the point. And there you have it. So I'd like to break this down in a more simple manner. So on a very basic level, if you're purchasing and placing in service everyday average run-of-the-mill equipment for your business, then it probably qualifies for both Section 179 and bonus depreciation. So as an example, if you're a photographer, you're purchasing cameras and lenses and so forth, and you're placing them into service, it probably qualifies for both Section 179 and bonus depreciation. Likewise, let's say you're an architect and you purchase a laptop for drafting and business purposes, that likely qualifies as well. But if you're looking at anything more exotic, like let's say you're purchasing computer software, intangible assets, or you're making improvements to real property such as land or buildings, then you definitely need to get a tax professional involved to help you determine if Section 179 is available, bonus depreciation, both or neither. And once you've narrowed down what's available to you, then you could strategize and see what makes most sense for your particular business. So with all that said, let's take a look at the differences between bonus depreciation and Section 179. And the best way to do that is with a handy dandy spreadsheet. Bet you didn't see that coming. All right, so right here we have the attributes of Section 179 over here, and also the attributes for bonus depreciation here. And we're going to be taking a look at them on a line-by-line basis and going from there. So with Section 179, the taxpayer must make the election to take advantage of Section 179. So this is not something that happens automatically. You have to go out of your way to make that election on your tax return. And the way you do that is on Form 4562. So right here in Part 1, there's the election to expense certain property under Section 179. So you fill out this part of the form, and essentially you've made the election. And it's a pretty straightforward process, but you have to keep in mind that if you forget to do it, then Section 179 isn't going to apply, and it's as if you didn't take it because you didn't fill out the proper election on this form. So on the other hand, with bonus depreciation, the weird quirk about it is that it applies automatically whether you make an election or not. So if you purchase and place in service an asset that qualifies for bonus depreciation, it's already happening for you. So if it costs $5,000, you can see a deduction on your tax return for the $5,000. You may be wondering what's going on here. What's happening is that the bonus depreciation is kicking in automatically because you did not opt out. So let's kind of see this in action here. Like taking a look at the tax return, we can see that we have an asset here. For this example, I just used equipment that's being depreciated for 5 years under makers, which is a concept that I'll cover in a later video. But essentially, it's your basic equipment. So if you're a photographer, it's a camera. If you are an architect, it might be your computer and so forth. So a lot of these items are depreciated over 5 years. So taking a look here, we have a asset that's placed in service costing $50,000. And let's just take out the Section 179 and take a look at the tax return. Now on Schedule C, we're seeing that there's $50,000 on line 13, which is deduction for depreciation, but we took out Section 179. What's going on? Now, if we go back to 4562, we could see that in Part 2, which says special depreciation allowance and other depreciation, we see that the special depreciation allowance is $50,000, and that's another way of saying bonus depreciation. So as we can see here, essentially bonus depreciation is being applied automatically without you having to do anything to take that deduction. Now, let's say you didn't want bonus depreciation. How can you get out of it? Well, the way you approach that is you have to elect out of bonus depreciation. So we actually have to do that in the tax software in multiple places. The first one being the election to not claim additional depreciation deduction, which is another way of saying bonus depreciation. So let's do that. And then in terms of the property class, we have to actually identify which property class we're electing out of for bonus depreciation. So we could just put something like 5-year makers. Okay, so now let's go to the depreciation section and finish this off because we want to say that we're not taking bonus depreciation on this equipment. Now, looking back at the 4562, we see that there's neither Section 179 or bonus depreciation. Looking back on Schedule C, we see that line 13 now has $10,000 in there, which is the regular sort of maker's depreciation being calculated. So we've taken bonus depreciation out of the equation. So the important thing to keep in mind is that unlike Section 179, where you have to make an election to take that deduction, with bonus depreciation, it applies automatically unless you make an election to opt out, okay? And the way that election looks is as follows. If we look at the tax return here, we could see this election to not claim additional depreciation, and it has a bit of a disclosure there, and ultimately it defines the specific class of assets that you're looking to be excluded from bonus depreciation for that tax year. Now, this doesn't carry forward to other tax years, so you can elect to have bonus depreciation not applied to different classes, but in 2018, for these purposes, all of the 5-year makers assets are not going to have bonus depreciation applied to them. All right? So that's how you go about electing out of bonus depreciation. You essentially have to include this election with your tax return to make sure that the basis for your assets is not reduced for bonus depreciation purposes. All right, so going back to the spreadsheet here, on number 2, we can see that you may elect Section 179 on a per property basis. So if you put into service 5 different computers, you can elect to take Section 179 on 2 of them and not on the other 3. So with Section 179, there's a lot of granularity in terms of how you want that deduction to apply and to which specific assets. Contrarily, with bonus depreciation, you actually have to opt out on a per property class basis. That's an important distinction. So Section 179, we're talking about opting in on a per property basis. Bonus depreciation, you're opting out on a per property class basis. So what does that mean? So if you have 7-year maker's property, you can opt out of bonus depreciation on all of that 7-year maker's property. You can't pick and choose specific assets where you don't want it to apply. You have to do it by class. Similarly, in our case, we had 5-year makers equipment that we're putting into use. In that case, we would have to opt out of 5-year maker's property. We couldn't pick and choose which assets we didn't want the bonus depreciation provision to apply to. So It's much less granular in terms of where it will and will not apply. And that's why in the tax return here, you're seeing that there's a specific election to opt out of bonus depreciation on 5-year maker's property because you have to do it on a per class basis. Contrarily, you can also approach it in a different way, and you could just opt out of all bonus depreciation. The way we do that is in the elections here. And instead of designating a specific property class, we could just say all eligible classes of property. And essentially what we're saying is we don't want bonus depreciation on any assets this year, and this is the way you do that. All right, so moving along, we can take a look at number 3 here, and essentially says that the taxpayer may choose the specific amount of Section 179 deduction allowance to be applied to each asset. So as I mentioned, Section 179 allows you to be extremely specific and picky with where it does and does not apply. So you can go on an asset by asset basis, and you can also specify how much Section 179 you want to take. So if you have a $100,000 asset that you purchased and placed in service in a particular year, you may elect to take $50,000 in Section 179. And on the other hand, you may elect to take $100,000, right? So you have a lot of flexibility there, and you can do it on a per asset basis. With bonus depreciation, it's essentially now an all or nothing deduction. And what that means is it's 100% of the acquisition cost of property purchased and placed in service in a particular year. Now, before the Tax Cuts and Jobs Act, bonus depreciation was actually 50% of the acquisition cost of property purchased and placed in service. The Tax Cuts and Jobs Act increased that to 100. So essentially, either you're taking the bonus depreciation on the full acquisition cost, or you're getting none at all by opting out. But you can't pick and choose the amount of bonus depreciation that you want. It's going to be done on a per property class basis, essentially, and you don't get the granularity that you get with Section 179 in terms of determining when and how to apply bonus depreciation. The other issue is that it's 100% for a limited time, right? So for a limited time only. For 2018 to 2022, the 100% bonus depreciation will be applicable. However, in later tax years, it starts to taper off. So as we can see here in 2023, it's 80%. So 80% is going to be the bonus depreciation that's allowable. And again, it's all or nothing. So you take 80% or zero by opting out for a particular property class. In 2024, it drops to 60%, 2025 to 40%, and then 2026 to 20%. So after 2026, who knows what's going to happen, because a lot of the provisions in the Tax Cuts and Jobs Act are set to sunset. So at that point, it's anybody's guess. But for the next few years, we kind of have it mapped out to where there's more of an incentive to put assets into service now as opposed to in 2025, let's say, because you get more of that bonus depreciation available. So it's kind of a use it or lose it kind of deal right now, whereas it starts to taper off in those future years, and you may want to front load some of your capital expenditures so that you can take more of an advantage of bonus depreciation. So that's something important to keep in mind. On a very basic level, with Section 179, you get to choose the assets, you get to choose the amounts. It's very flexible. Bonus depreciation is less flexible in that currently it's all or nothing, but in future tax years, it's essentially going to be either take 80% or nothing, 60% or nothing, and so forth. All right, so moving along, we'll get to number 4 here, and we see that Section 179 applies to both used and new assets. So with Section 179, it doesn't matter if you're buying an asset straight from the factory and it's brand new, it's got all the tags on there and all the original packaging and all of that, or you're buying it from Craigslist, from some third-party seller who bought it from somebody else. It doesn't matter. With Section 179, it's pretty flexible in that regard, so you don't have to worry about if it's a new asset or a used asset that you're purchasing, you're good to go. Now with bonus depreciation, it used to be that prior to the passage of the Tax Cuts and Jobs Act, you can only apply bonus depreciation to new assets, which means it's got the tags on it, it's got the beautiful packaging straight from the factory, and that was it. You couldn't go on Craigslist, buy a camera, and take bonus depreciation because that was a used asset that you were purchasing. The Tax Cuts and Jobs Act actually expanded the applicability of bonus depreciation to used items as well, but the stipulation is it has to be new to you as the taxpayer. So essentially what they're saying is that you can buy used items from an unrelated party, but if you had a cousin that all of a sudden sells you an asset, then that may have some limitations in terms of bonus depreciation. So this can get very tricky and nuanced in terms of when it applies specifically and when it doesn't, But the goal of this video, again, is just to keep it as simple as possible. So just keep in mind that in general, now with the passage of the Tax Cuts and Jobs Act, both Section 179 and bonus depreciation apply to both used and new assets for the most part. All right, so moving on to item number 5, we see that Section 179 is generally applicable for both federal and state income tax purposes. However, the applicable amounts can vary significantly. So it's important to keep in mind that you can take Section 179 at the federal level and you may be able to take it at the state level. However, the federal limit might be $1 million for Section 179 in a particular tax year, but the state limitation can be $25,000, could be $30,000, $50,000, what have you. There could be huge differences in how much Section 179 you're allowed to take at the federal level versus the state level, if the state even allows it at all. So whichever state that your business is operating in that's applicable to your company, you will have to figure out if Section 179 is available, and if so, how much, and what are the limitations that are involved. And it can vary extremely significantly. Like I said, it could be $1 million for federal, it could be $25,000 for state, and you have to track those separately as you move forward in time to make sure that you have accurate basis numbers at the federal and state level. Now, on the other hand, we see that for state income tax purposes, bonus depreciation is generally not applicable in many cases. However, some states do honor bonus depreciation, and how can you figure out which one's which? Well, you got to do your research. So in this case, there's a Bloomberg tax website here that has the state conformity with federal bonus depreciation rules. And as you can see, this is just a pleasant, beautiful read over here that if you're having trouble falling asleep one day, be sure to pull this up and figure out the differences between federal and state treatment of bonus depreciation. But I'm in California, so let's take a look at what California has to say about this matter. And we see that California does not conform to the federal treatment of bonus depreciation. So the way to approach this is really to do your research and see if bonus depreciation is applicable at the state level, because there is a good chance that it might not be. All right, so getting back to our spreadsheet here, we can see that Section 179 may not generate a loss for income tax purposes. So I covered this in the videos that I did on Section 179, and essentially, when you have, let's say, $50,000 in net business income before depreciation, and you put into service a $100,000 asset, you can only take Section 179 to bring your net income from business to zero. You cannot make it negative, so we can't create a loss with Section 179. We also can't exacerbate a loss, meaning that if your business is already in the red, or if you have negative net income or a net loss for the year, however you want to put it, you cannot use Section 179 at all. Essentially, you can elect the deduction, but it's going to be carried forward to future tax years. So the difference there is that with bonus depreciation, you can create losses and you can exacerbate losses. So that can create a planning opportunity if you have a business that's already losing money, but you want to create an even larger loss to offset other income. You may be able to do so by taking bonus depreciation over Section 179. So in situations where you have a loss, Section 179 may be elected, but it's not going to improve your tax situation. It's going to be carried forward. On the other hand, bonus depreciation can actually increase a loss, which may in some cases be used to offset other income and lower your tax liability. So in general, you don't see a bonus depreciation carryover because it can all be taken in a particular year, assuming you purchased and placed in service qualifying assets. So in that situation, there's a distinct difference in terms of planning from Section 179 and bonus depreciation. The other important aspect to consider is that bonus depreciation can actually create a net operating loss, which you then can carry forward or carry back depending on the federal and state rules at the time, but it couldn't create a tax benefit in the tax year that you take the loss or in other tax years to which that NOL may be applied. So that's an important distinction between Section 179 and bonus depreciation that should be taken into account. Now, number 7 takes a lot of taxpayers by surprise, and that's that assets that had Section 179 applied to them, if their business use percentage falls below 50% in a subsequent tax year, then you essentially have to recapture the difference between the Section 179 deduction taken and the ordinary depreciation that would be taken to that date on those assets. So essentially, if you have an asset that's used 55% for business purposes, you take Section 179, and in the subsequent year, it drops to 45%, then you may have to recapture the difference between the Section 179 taken and the depreciation you would have taken, and that's kind of a gotcha that is associated with Section 179 specifically. And I've seen many cases where this can surprise taxpayers if they have those assets that are kind of used for business but also kind of used for personal purposes as well. Now, on the other hand, bonus depreciation is not subject to that recapture provision, but it is subject to Section 1245 recapture, which is kind of a whole different item that we'll might cover in a different video. But to keep things on a very basic comparison level, to try to keep it as apples to apples as possible, Section 179, if the personal use exceeds 50% of a particular asset, then you'll be subject to recapture of Section 179, whereas bonus depreciation, that specific recapture provision is not applicable. So that was a brief breakdown of bonus depreciation. Hopefully this was helpful in shedding some light on the differences between bonus depreciation and Section 179. Now, with those two out of the way, we can focus on what's left, which is maker's depreciation. I promise I'll make a video on that to give you the full trifecta treatment, if you will. Now, if you like this video, feel free to comment, like, subscribe, and make sure you hit that bell icon to be notified of future videos as soon as they're released. With that said, hopefully this was helpful. Thanks for watching. Because as you can see, there's mountains and mountains of mountains and 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 mountains of mountains and mountains of mountains and